All right, let's talk about that little piece of plastic in your wallet, the credit card. We all have one, or at least we know someone who does. But what is it really? Is it a key to financial freedom, or is it a trap just waiting to spring? Today, we're going to break it all down.
So, let's start with a situation. Have you ever been in that spot where you absolutely need to buy something, like right now, but your bank account is, well, it's not quite on the same page?
Picture this. You're a student and boom, all your classes just got moved online. You need a new smartphone by tomorrow to even show up, but the money you're waiting for won't land in your account for another 3 days. What do? It's that classic problem, right? You have the money coming, just not right this second. And that's exactly where a credit card steps in.
Yeah, in a jam like that, a credit card can feel like an absolute lifesaver. But how does it actually work? How does this little piece of plastic solve your problem? Let's get into the mechanics.
At its heart, a credit card is really just a simple buy now, pay later deal. You can think of it as a pre-approved mini loan from a bank. They're not handing you cash, but they are giving you a card that lets you spend their money on the promise that you'll pay them back later.
The whole process breaks down into 3 pretty simple steps. 1, you swipe your card to buy that smartphone. 2, your bank immediately pays the store for you. And 3, at the end of the month, you pay the bank back for everything you bought. Sounds easy, right? But there's a catch.
Of course there's a catch. Before any bank is just going to hand over what's essentially a loan, they need to know if they can trust you to pay it back. And this is where that all-important number, your credit score, comes into play. It's basically their trust meter.
So, what is a credit score? Well, it's just a number, usually somewhere between 300 and 900, that acts like a financial report card. It tells banks how good you've been at paying back money you've borrowed in the past.
And this score is a huge deal. If you've got a high score, say up in the 750 to 900 range, the bank sees you as low risk. They trust you, so they'll probably give you a card with a nice high spending limit. But if your score is way down in the 300s, that's a huge red flag for them, and you might not even get a card at all. Your score is everything.
Okay, so now we get how they work. Let's talk about the fun part, the bright side. Because when you use them the right way, credit cards have some absolutely fantastic benefits that go way beyond just buying stuff when you're in a pinch. First, obviously they cover those immediate needs, just like our student who needed that phone. Second, and this is so important, they are way safer than debit cards. If someone steals your card info and goes on a shopping spree, it's the bank's money they're spending, not yours. You report the fraud and you're typically not liable for a single penny. On top of that, you get rewards. We're talking cashback, airline miles, travel points, and even free stuff like travel insurance. All right, we've seen the good stuff. Now we have to flip the coin and talk about the bad. Because if you're not careful, a credit card can turn into a very, very expensive problem really fast.
Just look at this number for a second. 30%. That could be the annual interest rate the bank charges you. And that right there is the single biggest danger. If you don't pay your bill in full and on time, that interest starts piling up. And it compounds, which means you start paying interest on top of the interest. That is how people fall into a debt spiral, where the interest grows so fast that it feels impossible to ever pay off what you originally bought.
The source material we're analyzing puts it pretty bluntly with this quote. It highlights a tough truth. A big chunk of a bank's income from credit cards can come from people not paying their bills on time.
This chart tells the whole story. See, banks make money from annual fees and late fees, sure, but look at that biggest slice of the pie. That's high interest payments on unpaid balances. So a huge part of their business model actually relies on people not paying off their card every month.
So you have the good and the bad, the convenience versus the cost. And all of this brings us to the most important part of this whole conversation, figuring out what this means for you.
This is really the only question that matters. It's not about whether credit cards are good or bad in general. It's about whether they're the right tool for your personality and your financial situation.
So, here's a little checklist to help you decide. First, and you have to be brutally honest with yourself, are you disciplined enough to pay the bill in full and on time, every single month? No exceptions. 2, are you using it to buy things you can actually afford? Or is it becoming an excuse to overspend? 3, do the math. Do the rewards you're going to earn actually cancel out any annual fees the card might have? And finally, how valuable is that extra layer of online security to you?
When you boil it all down, it really comes to this. If you are disciplined, you know you'll pay that bill in full every month, and you want those security and reward perks, then a credit card can be an amazing financial tool. But if there's even a small chance you'll be tempted to buy things you can't afford and get stuck carrying a balance, it is just not worth the risk of that debt trap.
So I'll leave you with this question to think about. When you look at that credit card, what do you see? A tool for convenience that makes your life easier, or a potential trap for your wallet? As we've seen today, the answer to that question is entirely up to you.